Ever wondered where your student loan or refinance money actually comes from? We often see names like LendKey, SoFi, or Sallie Mae, but is the name on the application the same as the name on the check? That's what we're diving into today, specifically focusing on LendKey and the question, is LendKey a direct lender? Let's paint a quick picture. You're looking to consolidate your student loans. You've got a bunch of different payments, interest rates are all over the place, and you just want one manageable monthly bill. You start researching online and come across LendKey. They advertise competitive rates, a streamlined application process, and seem like a solid option. But then you start digging a little deeper and you see terms like credit union partners and community banks. This raises the question, is LendKey actually the one lending me the money, or are they just a middleman? This is a crucial distinction. Knowing whether a company is a direct lender or a marketplace lender impacts several things, from interest rates and fees to customer service and the overall loan experience. A direct lender is the financial institution that originates and funds the loan directly. They use their own capital, set their own terms, and manage the loan throughout its life. Think of a traditional bank like Chase or Wells Fargo. They hold your deposit, they issue your mortgage, they handle your payments. They're the beginning and the end of the lending process. On the other hand, a marketplace lender, sometimes called a platform lender, acts as a bridge between borrowers and a network of investors or financial institutions. They don't use their own funds. Instead, they facilitate the connection. This model allows for greater flexibility and access to diverse funding sources, but it also means the marketplace lender isn't directly managing the loan servicing in the same way a direct lender would. So, where does LendKey fit into all of this? The short answer is, LendKey is not a direct lender. They operate as a technology platform that connects borrowers with a network of credit unions and community banks. They don't lend their own money. Instead, they provide the technology, the marketing, and the application processing for these smaller financial institutions. These institutions, the credit unions and community banks, are the actual lenders. This model has some interesting implications. Because LendKey partners with a variety of institutions, the loan terms, interest rates, and eligibility requirements can vary depending on which partner ultimately funds your loan. This can be both a benefit and a potential drawback. The benefit is that you might have access to a wider range of loan options than if you were dealing with a single direct lender. If one partner's criteria don't fit your profile, another might. The potential drawback is that the application process can sometimes feel less consistent. You might be dealing with different customer service representatives or different loan servicing platforms depending on which institution ends up funding your loan. Let's illustrate with an example. Imagine you apply for a student loan refinance through LendKey. Your application is reviewed and you're approved. However, the actual loan documents might show the name of a specific credit union in Ohio or a small community bank in Texas. LendKey facilitated the connection, but it's that credit union or bank that's actually providing the funds and will be listed as the lender of record. Now, why does LendKey operate this way? There are several reasons. Firstly, it allows smaller financial institutions, like credit unions and community banks, to compete with larger national lenders. These smaller institutions often have competitive interest rates and personalized customer service, but they lack the marketing reach and technological infrastructure of bigger players. LendKey provides that infrastructure, giving them access to a wider pool of borrowers. Secondly, this model allows LendKey to focus on its core competency, technology. They've built a sophisticated platform that streamlines the loan application, underwriting, and servicing processes. By not having to manage their own balance sheet and regulatory requirements associated with direct lending, they can focus on improving their technology and expanding their network of partners. Thirdly, it diversifies risk. By distributing loans across a network of lenders, the risk is spread out. If one institution experiences financial difficulties, it doesn't impact the entire lending operation. So, if you're considering using LendKey, what are the key takeaways? You're not borrowing directly from LendKey. The actual lender will be a credit union or community bank within their network. Loan terms can vary. Interest rates, fees, and eligibility criteria can differ depending on the specific lending partner. Customer service might be handled by different entities. You might interact with LendKey during the initial application process, but subsequent servicing might be handled by the lending partner. Access to a wider range of options. The network model can provide access to more diverse loan products and potentially more competitive rates. It's important to carefully review the loan documents and understand who the actual lender is before finalizing any loan agreement. This will help you avoid any confusion down the line when it comes to making payments, contacting customer service, or managing your loan. Understanding the difference between direct lenders and marketplace lenders is crucial for making informed financial decisions. When it comes to LendKey, remember they are the facilitator, the connector, the technology platform, but not the actual lender. This distinction is key to navigating the loan process and understanding who your ultimate